Yeah, so with that, I think we could jump into today's session. All of the news as of late has been this uniform guidance update. It's been highly anticipated. I think at the National Grants Management Association conference in 2023, OMB had announced that it was going to be a full rewrite of uniform guidance, and this made a lot of people nervous at the time. But what ultimately ended up happening is, I think, not a full rewrite, but definitely a significant improvement. And there's a lot of kind of opportunities and new flexibilities for recipients. And then there's also some risk areas, some new risk areas that were not advertised by OMB, of course. They're not necessarily things that I think are going to make your life easier as a grant recipient. They could bring new risks. So we're going to talk about all that today in today's session. So just a quick introduction. As I said, I'm Dan Durst. I'm the executive director at GMI. I'm an experienced management consultant. So I began my career as an auditor many years ago, conducting single audits. And ultimately, when uniform guidance was first issued, I made the transition from auditing to consulting. And I've been consulting federal grant recipients ever since. The areas of focus that I tend to be in support of my clients on are compliance and cost allocation. So compliance with uniform guidance, compliance with federal acquisition regulation, and then, cost allocation strategy as it relates to not only the direct charging on federal grants, but also your indirect cost rates and indirect cost recovery strategies as well. Being a former auditor, a recovering auditor, I like to tell people now I'm in the business of clean audits only, in that, when I'm supporting an audit nowadays, it's typically on behalf of my clients that are being audited. And really, my goal is always to get them to clean audits. So I'm now only in the business of clean audits. I'm based in the Washington, D.C. metro area. I've actually got an office on Pennsylvania Avenue down there that I'm consulting with now out of. And yeah, I'm kind of born and raised in this area, so I've been around federal funding my entire life. And I'm a Pisces, so I'm a water lover, and typically make it to the Eastern Shore this time of year to visit the beach. So a little tidbit about myself. So in terms of the agenda for today, we're going to talk about, first, how do we get here, right? Like what was the process by which we've got to this point where we've got now this, kind of huge revision to uniform guidance that's going to impact all of our lives as federal grant recipients and service providers. And so this is going to be somewhat of a quick history lesson to bring everybody up to speed of where we came from and where we are today. Then we're going to talk about the effective date. The effective date is a little complicated, and we'll kind of discuss how you and your clients can kind of navigate that and plan for that moving forward. We'll talk through an overview of these revisions. So what was the primary purpose? What was OMB's motivation for making these revisions? And, ultimately we can, have a little discussion about whether or not we think that those objectives were met. We'll touch on the good news. OMB was very keen to announce all of the good news, of course, as I'm sure you heard about all of the threshold increases and the new flexibilities that were included. But we'll also touch on the bad news. And so, at the end of the presentation, we've actually got a link to some resources for you guys that has a red line copy of uniform guidance. And it's very helpful when looking at a specific section. If you want to know, specifically how did they adjust this requirement, so that you can apply it to the use case that you have in your operations, that red line copy is very handy. So I read through the entire red line copy. I kind of save you the trouble. I went through all of those sections and try to distill out the ones that I think represent some additional risks to recipients that we'll talk about when we discuss the bad news. And then we'll do some Q&A. If you have questions, feel free to put them in the Q&A box throughout the presentation. We're going to take time at the end of the presentation to answer the questions, and I'll basically just address them in the order in which they were received. So feel free to populate your questions as they come to mind, okay? All right, so quick history lesson. How did we get here? Well, looking back pre-uniform guidance, prior to December 26, 2013, federal grants were previously administered under the old OMB circulars, right? So you had OMB A122, OMB A133, and it brought together all of the pieces that uniform guidance represents now. So it brought together administrative requirements, it brought together cost principles, it brought audit requirements. Well, now uniform guidance contains all of those things within itself, and it's basically just broken out into specific subparts, right? A through F. And so on December 26, 2013, OMB issued this final guidance called Uniform Guidance, or Uniform Grant Guidance, as you hear it referred to in many of the industry periodicals and whatnot. And so this initial set of uniform guidance was then, we call it Uniform Guidance 1.0. It was put into effect for awards issued on or after December 26, 2014. For me, this was really the turning point where I started transitioning from audit to consulting, because in many ways, when uniform guidance was first issued, the federal government was not giving you additional funding in your grants to learn and adapt to these new requirements and really help you become compliant. And so there was a big knowledge gap. I think in many ways, there's still a knowledge gap in terms of what are the expectations when receiving federal grants with respect to compliance. What are we expected to do so that we can get clean audits and we can continue fulfilling these programs? So this was a turning point really for a lot of folks where you had to really kind of invest yourself to learn these new requirements that were included in uniform guidance. As uniform guidance first started, being applied, as you probably know today, uniform guidance is not uniform. You'll hear that quite a bit. And ultimately, what folks are trying to communicate there is that in addition to uniform guidance, which is OMB's guidance, there are also agency supplements that specifically apply to funding that they award or that they issue. So, for example, Department of Energy under 2 CFR 910. You've also got HHS has codified their own version of uniform guidance in 45 CFR 75. A lot of it is the same, but there are some differences, and it creates confusion for folks. So, as part of this initial publishing a Uniform Guidance 1.0, there was the expectation that it would need to be updated as things were learned, as the regulations, and kind of the operations of these grant programs changed over time. And so there was a mandate in there that uniform guidance would be updated about every 5 years. And so OMB kind of stayed true to that in August 13th of 2020. And OMB issued its first kind of multi-part revision to uniform guidance on that date. When it was first issued on August 13th, there was actually 2 provisions that were applicable that same day and immediately, and that was the prohibition on covered telecommunication devices and video surveillance equipment, the prohibition on certain Chinese national manufacturers, and then also some of the termination provisions that were included that strengthened the federal government's ability to terminate your award if it no longer met the agency's, essentially their initiatives or their goals. From there, though, the rest of the revisions, they were put into effect for awards issued on or after November 12th, 2020. So this was kind of the first, kind of instance of applicability of Uniform Guidance 2.0. And then from there, come around another 4 or 5 years, we were right back in that cycle. And so on April 22nd, 2024, OMB issued the latest and most comprehensive revision to Uniform Guidance, which we would refer to as Uniform Guidance 3.0. And that brings us to today. And so, your next logical question is probably, well, when should we expect this thing to be effective? Your eyes are not deceiving you. You're not having vision problems. The effective date is fuzzy. It's unclear, as you can see on the slide. Ultimately, the effective date for this final guidance is October 1, 2024. Okay, that's what it says in the Federal Register in the final rule. However, there is a kind of a gray area there. Federal awarding agencies may elect to apply the final guidance to federal awards issued prior to October 1, 2024, but they're not required to do so. So you can have early agency adopters, essentially. For agencies applying the final guidance before October 1, 2024, the effective date must be no later than June 21, 2024. And I think the expectation is going to be for many of the requirements, it's going to be that it'll apply to awards issued on or after those dates. So, what does that mean? Ultimately, I would say for you, it's important to know who your funder is, identify each of the funding agencies associated with your grants, and then make sure that you're monitoring, kind of the grant agreements that you're being presented with, or the amendments or modifications that you're receiving on existing grants. They could start appearing as early as June 21st, 2024. Okay. Other agencies, potentially, I would say like HHS, for example, who knows? They might wait all the way until October because they need to figure out how they're going to either revise or administer, 45 CFR 75 along with these revisions to uniform guidance. Ultimately, 45 CFR 75 wasn't updated for many of the revisions in November of 2020. So should there be an expectation that they're going to make these revisions in 2024? I don't know. I think it'll be yet to be seen. But you'll want to start paying attention to this starting June 21st. So, as I mentioned, not super clear, but you could expect it to be coming in effect, very quickly, based on your funding agency's implementation guidance. Okay. So, what is kind of the overall purpose of these revisions? What was their goal? And why did they make these changes? Well, OMB's stated goal is that these revisions were to improve stewardship of federal funds, promote equitable access to programs and services, reduce administrative burden for agencies, applicants, and recipients, and facilitate streamlined and effective oversight and implementation of federal programs. That's a lot of kind of like word salad, and at the end of the day, I think they likely did achieve a lot of those things. I think if you had to distill it down to what actually happened in action, is that the revisions did eliminate several prior approval requirements. They increased multiple thresholds that trigger additional requirements, such as equipment and supplies, that we'll talk about in a second. And then they also clarified requirements for agencies and recipients, in that much of the revision was somewhat of it was almost as if it was a grammatical and a clarity type of revision, where essentially there were some sections where the requirement didn't change, but maybe the paragraph or the area in which that requirement was addressed was completely reworded. Throughout the entire document, the mentions of non-federal entity in most cases were then transitioned to recipient and subrecipient, for example. So there's a lot of kind of clarifying and just making uniform guidance a lot more user friendly, kind of eliminating some of the legalese of the document previously. So the actual structure itself is pretty much the same. So if you were comfortable with navigating uniform guidance previously, you're going to be comfortable with navigating uniform guidance in the current rendition as well. The subparts remain the same, but many of the kind of the way that things were worded and the terminology was adjusted for clarity, which I think was definitely achieved. Okay, so the good news, right? This is all the stuff that you heard about in the press releases. This is all the stuff that OMB mentioned in their initial, kind of delivery conference that they had, I think, at the Capitol. I will say there was quite a few good things to come out of this revision for recipients. So the positive revisions that I think were most impactful kind of consist of the following here. So in subpart A, the definitions were revised for equipment and modified total direct cost. And we'll talk about, how those revisions were made and what the result of that actually is. But ultimately, those definition revisions will essentially benefit, recipients once you look at how the revised definitions are going to be applied. In the case of equipment, it's an increased threshold. In the case of modified total direct costs, it's an increase in the amount of subaward costs that you can include in the allocation base, which is going to be beneficial if your allocation base is modified total direct cost. Um, in Subpart D, right, in the post-award administrative requirements, fixed amount awards had the ceiling value increased from 250,000 to 500,000. I'm hoping this will encourage the additional adoption of fixed amount awards. There's been many clients that I've worked with over the years that didn't know that that was an option available to them. And so I think by going from 250,000 to 500,000, we should have more use cases, I think, right? Generally, looking at what the average value of a grant in USA spending, it's usually like 1.2 million. But of a subaward, you could have subawards probably that are less than $500,000, pretty consistently. So it could be a great way to reduce administrative burden for those pass-through entity subrecipient relationships, and we'll kind of talk about why. Removal of a prohibition on the geographic preference in procurement. So this was an item that's been in Subpart D in the procurement standards since its inception. And ultimately, what it was doing is it was limiting, basically state or local government imposed geographic preferences for procurements of goods and services. So basically saying, previously, if an organization or an entity wanted to only procure from, let's say, its jurisdiction, it was prohibited. You weren't allowed to do that when spending with federal funds. This has since been lifted. So it was essentially just deleted directly from the guidance. So now, if this is something that would benefit, the entity for any particular reason, maybe you only want to, solicit or stimulate the economy within your immediate area, and you want to solicit proposals from your immediate geographic area. Now, ultimately, that option is on the table. Subpart E, under the cost principles, the de minimis indirect rate increase. This got a lot of kind of publicity, and I think a lot of folks saw this as a good step in the right direction. Do I think that it would, help organizations break even on grants using the de minimis rate? I don't think it's gotten us that far. I think that there's still room to go. I think especially for our smaller organizations, a higher rate than 15% would be better for them. For some of the larger organizations, 15, 10%, they actually could probably get by with that because they have such a large base that they're allocating their administrative cost over, that it might make sense. But for the small ones, the ones that really need the funding, the ones that don't have huge endowments and unrestricted cash reserves, the 15% likely not going to get the job done for them. In Subpart E, under the prior approval requirements, they also removed certain costs from the prior approval cost principle, basically saying that for the allowable portions of entertainment, membership, subscriptions, professional activity costs, and participant support costs, you don't have to get prior approval now. So that was, kind of a good step forward in reducing the administrative burden from a budget management perspective. In Subpart E, they removed the DS2 requirement for institutions of higher education. These are large institutions that previously had to do this, that received greater than $50 million in likely research and development funding. The DS2 is a disclosure statement that has to be filed pursuant to the cost accounting standards. And it basically is like a disclosure of what their cost accounting practices are for federal awards. And so they've eliminated this requirement, with the one caveat that if you still have a CAS covered contract with the federal government, you would still be required to do your disclosure statement. So don't think that this completely eliminates that requirement. It's just that it wouldn't apply to grant funding anymore. So if you only had grant funding, you're not going to be filling out a DS2 to submit. It would only be your CAS covered work. Subpart F, the single audit threshold increased. So this was good because, in looking at the single audit, data and information, this is probably going to eliminate maybe a few hundred single audits every year that are being done for organizations that receive, less than $1 million and expend less than $1 million in federal funding each year. So, as the grants keep getting bigger, I think that, organizations are going to catch up to this threshold. They'll have to just increase it again one day. But I think as of now, even today, the availability of auditors to conduct all these single audits is has just been a really difficult situation. I think there's somewhat of an accountant shortage, anyways. And so when you think about first through the pandemic, and then through the relief effort, and now through the investments in infrastructure and clean energy, the demand for single audit services has skyrocketed. And so this should reduce some of those very small ones and eliminate them and eliminate that requirement for some of those folks. And then there was some other benefits as well that we'll dive into in a little bit more detail. So just starting with the first one, equipment. As I mentioned, the definition for equipment was revised, and so I kind of have a this format for each of the revisions we're going to look at. On the left is the current definition or current text as it's in uniform guidance, and then on the right is the revised version. And so you can see that the major change here was that the $5,000 threshold for equipment. So basically, if you have a piece of property that has a useful life of greater than 1 year and a per unit acquisition cost of greater than $5,000, it's considered equipment under your federal grant. Now it's going to be a useful life of 1 year and $10,000 in per unit value. So um, the item that maybe you bought, like the generator that cost $7,500, or the copier that you bought that was $7,500, less than $10,000 now. It won't need to be managed in accordance with the requirements of equipment as it previously was. And so, if you're familiar with those requirements, with equipment, you have to maintain it on a ledger, listing of all the equipment. You have to inventory it once every 2 years. You have to formally request disposition instructions when getting rid of equipment. Usually, it's best practice to tag equipment with unique identifiers. So there's definitely a reduction in administrative burden here, in that you're going to have things that will probably fall off of your management list as a result of this increased threshold. Now, supplies, which will now be referred to as supply in the updated Uniform Guidance 3.0, it's also impacted by that definition change, because basically everything that is not equipment, anything that's below that, less than $5,000 currently, or less than a useful life of 1 year, is considered a supply. And supplies are much more kind of flexible in the way that you manage them. Ultimately, throughout the period of performance of the award, there isn't really any major management requirement other that you don't, have any waste. You're not just, kind of wasting funds, buying supplies. But ultimately, that threshold is increased to align with the equipment definition now. So really what you're getting is that increased flexibility for those items between $5,000 and $10,000 that you used to categorize as equipment. Now they're going to fall under the definition of supply, which is much more lax. Okay, they don't have to be inventoried and things like that. Just keep in mind, there is a requirement that that you kind of assess the value of any unopened or unused supplies at the end of the award, and you're supposed to request disposition instructions, or basically compensate the federal government for any of that remaining value that may be there for those supplies. So if you have like an unopened case of whatever, and it's greater than $10,000 in value of supplies in aggregate, you're supposed to compensate the federal government back. Now, if it's an open package, that doesn't count, right? That would be considered a fair market value of zero. So just keep that in mind. All in all, it's a good, the definition is going to result in a good reduction in administrative burden for, for recipients. Modified total direct costs. So modified total direct cost is probably one of the most common allocation bases utilized by grant recipients. So there's always a lot of discussion around the definition of what is modified total direct cost. Well, modified total direct cost is exactly what it sounds like. You take your total direct cost and then you modify it for certain things. And the way that you modify it is actually not uniform necessarily from one cognizant agency to the next. You may have some modifications that are different than others, from organization to organization. Indirect rates are usually a pretty unique, somewhat of a cost fingerprint of an organization. So one organization's modified total direct cost may be different than another. But one thing to know is for the purposes of your de minimis rate application, if you use the de minimis rate, it always reverts back to the standard definition that's in uniform guidance. And so that's what was changed here. So modified total direct cost means all direct salaries, wages, applicable fringe benefits, materials, supplies, services, including contracts, I believe. You should always argue for that. Travel, and then up to the first 25,000 of each subaward. And so that was what it is today. It's been revised to allow for the first $50,000 to be included of each subaward. And so basically you're going to get double the indirect cost recovery on subawards if they're in your grant budget, which is a good thing. Um, is it going to completely pay for all of the costs that it's going to take to administer that subrecipient and those subawards? Probably not. Um, with the increased responsibilities for pass-through entities that came as a result of uniform guidance introduction, with respect to risk assessments and monitoring, it became very burdensome and costly to manage these subawards. And so I think really it shouldn't be 50,000, it should be 250,000. But as of right now, at least it's a step in the right direction, and it's going from 25,000 to 50,000. The de minimis rate, and then I'm going to kind of bring these two together for you on the next slide, but the de minimis rate was also increased. And so the de minimis rate, if you're not familiar, it's basically an election. It's basically saying, we are not going to calculate and negotiate our indirect rates with you. We're going to elect to charge a default rate on modified total direct cost, which is the definition we just looked at. And so currently the de minimis rate is stated at 10% of modified total direct cost. The language was revised to basically say now that you could charge up to 15% modified total direct cost as your de minimis rate. So this is great. It's an additional, 50% of what you were getting before, right? And ultimately, for an organization that has a significant base, a significant modified total direct cost base, it could result in a lot of new unrestricted revenue coming into the organization. And so what does this look like when you kind of put the two together? When you think about your budgets and how this would be impacted, if you think about you have a subaward that's maybe $100,000 to another nonprofit or another entity that you're partnering with on the program, modified total direct cost of that subaward would be under the current regulation $25,000, and then at the current de minimis rate, you'd get 10% of that. So the most that you are going to be recovering on your subawards if you're electing the de minimis rate under the current regulation would be $2,500, which is really not a lot, right? With risk assessments and monitoring and everything that you pay your grant managers to, do to manage those relationships with the subrecipients, that $2,500 is going to get spent really quickly. Under the new revised uniform guidance, that same subaward that's $100,000, now $50,000 we can include in the modified total direct cost allocation base. And when you combine that with the fact that now the de minimis rate is 15%, now your indirect cost recovery is more like $7,500. And so the additional cost recovery per subrecipient could potentially be, if you're using the de minimis rate, $5,000. And so that additional $5,000 should get you, hopefully closer to break even with respect to the effort and time that you have to put in to manage those subs. So I think, when you look at it collectively, it's going to have a good positive impact. Again, I don't think that it's sufficient to adequately cover your true cost, but it's definitely a step in the right direction. If you were to think about how the revised modified total direct cost allocation-based inclusion will affect you folks that negotiate your rates, basically you would take that de minimis rate of 15% and plug in whatever your negotiated rate is, let's say 25%, and then that would be your additional, cost recovery as it relates to the subaward. So definitely a step in the right direction. Okay, so Moving on to fixed amount subawards. So again, the reason fixed amount subawards are great is because essentially you use cost to estimate what you think the effort, and the implementation support of the subrecipient is going to, take in terms of cost. So you use the cost principles, you use labor estimates, fringe benefits, supplies, everything, and you come up with an estimate. Let's say the estimate is $250,000. Then you create an agreement with them that is milestone driven. And so each milestone will result in a lump sum payment for a particular amount. Let's say if it's, 10 milestones, $250,000, each milestone is $25,000, right? As they meet those milestones, say submitting a progress report or passing a field site visit or something of that nature, you're able to make those lump sum payments without having to look at actual costs incurred of the subrecipient. And so you can imagine from an administrative burden perspective, when you have a subrecipient that's performing on a fixed amount subaward, the amount of information they have to accumulate related to the award, the amount of processing time it takes to submit reports and requests for reimbursements and everything else, it really kind of simplifies that process. And also, when you think about from an audit risk perspective, as long as they met the milestones in the fixed amount award, they were eligible and entitled to receive the payment that was, outlined within the fixed amount award. So there is no kind of going back and auditing. Well, you know, what did that individual put on their timesheet for that fixed amount award? How many hours did they spend on that fixed amount award? How much was the invoice for that, stack of paper that you bought as supplies in support of that fixed amount award? There is never really that transactional review of the costs that were incurred to get you to that point. I think the reason fixed amount awards were not used as much previously is because they were originally capped out or topped off at the simplified acquisition threshold, which is currently $250,000. And so now they raised the ceiling value to where fixed amount subawards could be $500,000 in value. And so when you think about, subawards you issue, any of the subawards you issue that are $500,000 or less today, if it makes sense for the activities they're performing, you could turn those into milestone based subawards. Keep in mind, you do have to get prior written approval from the awarding agency or past attorney to do this. But it could be something that really makes that relationship between you and the subrecipient that much more easy to manage. Because ultimately, if they meet the milestones, they're entitled to the payment. You make those payments. You don't have to get into the weeds in terms of how much they actually spent and things of that nature. Okay. All right, and then the audit requirement. So as we discussed initially, right, the audit requirement is changing. So previously, or I would say currently, a non-federal entity that expends 750,000 or more during the entity's fiscal year has to have an audit conducted. And so if you have multiple programs under multiple programs that you implement from an assistance listing number perspective, you should be then getting a single audit, which would basically test them all at once. If you have just a single program, then you may be eligible to elect a program specific audit, which really kind of narrows the scope and ultimately just focuses on that particular audit. And so, really, when you think about who this is going to benefit, it's going to be the organizations that just tripped the single audit threshold. Just went from 650,000 to 750,000 over the last year, and now they're like, oh shoot, we got to engage an independent auditor. We got to do this audit, right? Well, now the threshold is increasing to $1 million. So there's going to be some folks that'll fall off and not have to have the audit conducted anymore. One thing that, when I'm working with clients, I always advise them is like, have control over your budget, because we'll have some where, basically they'll have like $1 million award, and it's a 2-year award, and they will spend all of, like $780,000 or whatever it may be, like more than the threshold in the first year, when there's a lot of things that really they could have probably, you know, hold off on until the second year to avoid the threshold. and just stay under the $750,000 threshold. And so, kind of keep the audit threshold in mind if you're hovering around that level, because if you come in at, $999,000, you do not have to have the audit conducted. And keep in mind, it's going to be all of your direct costs plus indirect costs on top that ultimately will measure, whether or not you have to have the audit done or not. But it could be the difference between, having a non-compliance finding, having to go through the audit, which can take weeks or months to complete, and not having it done. And you could trip the threshold by as little as, $100, and ultimately be in a position where you have to have it done. So, all right, some of the other items that I don't have detailed slide materials on, but I think are worth mentioning, and if this applies to you, it's definitely worth checking out. In 200-307 under program income, there was actually acknowledgement and kind of clarity added in there, a paragraph to address what happens with programs that generate program income after the period of performance of the project. We're actually seeing this quite a bit today with respect to a lot of these capital, um, the Biden infrastructure law, and then also the Inflation Reduction Act projects, where maybe they're building a new facility that's going to manufacture, new battery materials, or maybe it's a solar farm that's going to generate electricity or something of that nature. Those are going to be kind of like income producing projects into the future, not just during the period of performance. And so there's been a lot of questions about, like, well, what happens to the program income, right? Like, does, 10 years down the road after the project's completed, are we on the hook to, give that income back to the federal government? Do we have to pay them back in some way? And so there's a new paragraph that's added in there that acknowledges that in some situations there will be no further obligation beyond the period of performance. And so, obviously, a good step in the right direction for folks that are in that situation. At 200-318, a lot of organizations or a lot of entities that wanted to conduct procurement through strategic sourcing or shared service agreements, or like inter-entity agreements or intergovernmental agreements. I think for a long time there was a question about, if we piggyback on that, shared purchasing catalog, is that going to satisfy the competition requirements, uniform guidance? Or is that going to, are we still going to have to substantiate our own competitive process? And so in 200-318, they actually included some explicit guidance on how some of these strategic sourcing and shared services agreements do satisfy the competition requirements, uniform guidance. And so it kind of eliminates some of that ambiguity and should help folks proceed in using those with confidence moving forward, especially if they have a close relationship with, say, a state government or a local government that has, somewhat of a bargain purchase arrangement with a number of vendors. It's already been pre-negotiated and there's already advantageous pricing going on. At 200-403H, when looking at closeout, there was always this period of time in which the period of performance has ended. You had, as a recipient, 120 days to liquidate your final obligations and file your final financial report. Well, what about the administrative costs that we incur after the period of performance end date, but before the final financial report goes in? What happens to that cost? That administrative cost, that time that our teams are spending, to process those things. A lot of times, folks would have to reach out to the awarding agency to get like prior approval to charge any of that cost. It created this kind of like really complicated and confusing situation of where that cost should go. Other organizations would just eat the cost, put it in their indirect costs, and just not seek reimbursement directly from the grant for those costs. And so one thing to know now is that it calls out specifically in the cost principles that you can charge these administrative closeout costs to the current grant, even though it's after the period of performance, but it has to be basically incurred after the period of performance, but before the final financial report is due, so that 120-day period. For subrecipients, it would be 90-day period. And you charge it to the final period of the grant. So the final, quarter, final month, you would charge it, basically, you backdate it to that final closeout period. So definitely a good area that was addressed by the revisions. And I think a lot of folks should hopefully be able to take advantage of that as you're closing out your grants. Under 204.14, there was a requirement in the November 2020 Uniform Guidance Update that was requiring that indirect rates and their base were published on a U.S. government website due to a significant amount of pushback from both the higher education community and then also large, sophisticated nonprofit organizations that have negotiated rates. This was actually removed in the latest revision. And so this is great. It's going to protect the integrity of your indirect rate structure. You're not going to have, your competitor, the other nonprofit that you're competing against, knowing what your indirect rates are and things like that. So definitely a step in the right direction, and I'm glad they listened to the public on those elements. All right, so we talked about the good news, and hopefully everyone sees some benefit from those things. There's always there's always kind of a caveat. There's always some things that don't make it into the press release that are going to create additional risk, right? It can't all be rainbows and roses, right? So that's what we're going to talk about now. And these are just some of the initial areas that I identified. There could be more as you kind of dig in further. Those things will kind of be experienced over time, but these are some of the ones that were pretty obvious in terms of how they stood out in the revisions. So which ones represent additional risk to recipients? The first one, which I think for any of the attorneys on the line, or if you have a grant specific attorney, which I highly recommend supporting your organization, one to be aware of is the revision to 113 mandatory disclosures. They've essentially kind of it accelerated the timeline in which an organization would need to disclose certain instances of criminal activity and other fraud, waste, and abuse items, in connection with your grants. So previously, we'll talk about the revisions, specifically the language, but another one is 200-217. So ultimately, previously under the, under subpart B in 217, there was previously a mention of whistleblower protections, but it was only mentioned in passing. And so I think in many ways, a lot of organizations were complying by luck because they didn't put in policy how they were going to protect whistleblowers or even whether they were going to have a whistleblower program. It was more of a passive compliance in that no one had whistleblowed and they hadn't gone after any of those whistleblowers. So it never became an issue. Well, now these requirements with respect to whistleblower protections are explicitly stated in detail in 200-217. So as a result of this, I'm expecting to see more kind of formal whistleblower programs and things like that rolled out at organizations to protect against fraud, waste, and abuse on federal government programs. At 200-303, internal controls, this is basically where it says you have to have internal controls over compliance and provide reasonable assurance that you're going to comply with uniform guidance and laws and regulations. This is also the section where it talks about protecting personally identifiable information and other information. They kind of leave that other information category out there. Well, they've actually inserted the term cybersecurity now as well. So you don't just need internal controls, you need internal controls and certain cybersecurity controls as well to protect the integrity of the information that you're getting access to in the federal program. So why is this important? Well, if you have grants and contracts, you'll know that on the contract side, there has been a lot of chatter around cybersecurity and a lot of investment because there are new regulatory requirements coming out in the DoD community and also now in the civilian contractor community, where cybersecurity kind of minimum standards are expected and enforced through compliance on certain pieces of information. So one thing I would say, and that I've noticed over my 15-year career around this uniform guidance regulation, the OMB circulars before, a lot of the pieces that are in the federal acquisition regulation for contractors, a lot of the pieces that are put in place for our DoD contracting community, many of them find their way into grant regulation. And so this cybersecurity mention could be the start of you needing to invest in cybersecurity controls at your nonprofit or your state government or your local government or your institution of higher education, wherever you represent. Um, and I wouldn't expect to see, or I wouldn't be shocked to see new additional requirements come out related to cybersecurity in the coming months and years as it relates to grant funded programs. Okay. On cost share, they made a revision, essentially to discourage awarding agencies from using voluntary cost share as a selection criteria for the award of research and development and other financial assistance awards. So NSF, for example, has always, or for a long time, has had a policy of not allowing voluntary cost share in proposals because they didn't want it to kind of skew the merit review process and whether or not research and development programs should be funded or not. So now they've kind of, in the regulation here, they've kind of expanded that a little bit further to say, and other financial assistance awards as well. In terms of equipment, they've kind of strengthened the management requirements there. We'll look at that. In 203.18, under conflicts of interest, they've mentioned the word board member now like 8 times. So what this tells me is that there's probably been quite a few instances of conflicts of interest with respect to board members and self-dealing at your, institution of higher education or nonprofit or whatever entity type you are. So it's something to be aware of. I would expect this to be on the radar of your auditors and also of your awarding agency to scrutinize board member dealings and potential business between the entity and them as it relates to the federal grants. And then closeout, they added some language to clarify something that has been in place for a long time, but for a long time, organizations, I think in many ways have been somewhat ignoring it. It could come back to surprise folks. So mandatory disclosures, I have of course, the current on the left, the revised on the right. The key takeaway here is that previously it said you needed to report in writing to the federal awarding agency all violations of federal criminal law involving fraud, bribery, gratuity, so on and so forth, right? Now it's revised to say you must promptly disclose whenever, in connection with a federal award, including any activities or subawards, it has credible evidence of the commission of a violation of a federal criminal law involving fraud. They added conflict of interest as well, bribery or gratuity violations found in Title 18 of the Civil False Claims Act. So ultimately, I think this has somewhat raised the bar in terms of risk for you grant recipients, in that now not only is it just confirmed instances of violations of federal criminal law, so on and so forth, right? Now it's if you have credible evidence, right? So if you have credible evidence from a subrecipient, from a whistleblower, from whoever, now you have to notify the federal awarding agency. You can't wait for it to be confirmed. If you have credible evidence, you have to notify, and you could potentially be, like reprimanded if you don't make that mandatory disclosure when you have that credible evidence. And the fact that they've included now conflict of interest as well is a little bit concerning, because you could have real or perceived conflict of interest, and if you mitigate those, sometimes they're not an issue, right? You can alleviate a conflict of interest by putting in certain measures. Well, this is kind of putting in a level of scrutiny there. We're like, what do they want us to report as it relates to conflicts of interest? I'll leave this to our legal colleagues to discern and advise you on, because this is really good, kind of gets into that arena more so than kind of a cost accounting world. So but I just thought it was an interesting inclusion, and obviously these are ones that OMB didn't advertise. 203.06. So again, under cost sharing, basically what happened here is that previously it said that voluntary cost share could not be used as a factor when doing a merit review on applications or proposals for research and development related funding. Well, now it's gone a little bit further to say that the federal awarding agency may not use voluntary committed cost share unless, and it's got some very specific or limited guidelines there. And then it also says federal agencies are also discouraged from using voluntary committed cost share as a factor during merit review of applications for other federal financial assistance programs. Well, in my experience, I've seen a lot of that done in some of these infrastructure and clean energy awards, where If you have a commercial company or for-profit bringing more cost share than, let's say, the other one, the other applicant, in my mind, that was certainly being used as one of the factors to kind of say like, oh well, the minimum cost share is 50%, but we really like the people that will contribute 300% cost share. So this may impact the ability for organizations to use that as a kind of a competitive differentiator. Equipment. So yes, they did revise the definition of equipment to eliminate those items less than $10,000 now, and they're going to be supplies. As you know, with equipment today, you're supposed to be maintaining an equipment ledger so that you can manage and inventory the pieces of equipment you get on grants. They've gone and added some language here that I think is going to increase, kind of the view from auditors of this specific issue. And the piece that they added there is on the right in the bold, and it says the recipient, subrecipient responsible for maintaining and updating the property records when there is a change in the status of the property. So it's not enough to just record the property when it comes in. When you're doing your inventories, you have to actually manage that property. If a custodian, an individual who's who's overseeing that property changes, you have to change the custodian in your listing. You have to change the location. You have to change the use, right? All of the data elements that they're requiring you to keep in that ledger, you have to keep that stuff maintained. It has to be accurate and current. And really, I think what this could do is shed some additional light during your single audit, and they may start looking at it more closely. So as it relates to indirect costs, we have an update here that, ultimately what they said at closeout typically is that, you have to submit all of your financial reports 120 days after the end of the period of performance. Subrecipients have to submit 90 days after the end of the period of performance. Well, one of the things that's existed for a long time now, and I think it kind of flew under the radar for a significant period of time, was what do you do with indirect rates when you don't have your final rate at closeout? Well, they added some language to clarify this process and really make it clear to recipients what their responsibilities are. And so what they added is in the bold on the right, and it says, when recipients do not have final indirect rates covering the period of performance, a final financial report must still be submitted to fulfill the requirements of the section. The recipient must submit a revised final financial report when all applicable indirect cost rates have been finalized. So how many of you have closed out a grant with your provisional rates, received a final rate, 8 months, 10 months later, and then not submitted a revised final financial report, on that grant that you closed out, right? This is clarifying that technically you're in non-compliance there. You need to submit that final financial report that's revised to include the final rate. And God forbid your final rate comes in lower than your provisional rate, that they're going to be asking for the money back. So just keep that in